Let's dive right in. Gold sitting at $4,062. Silver at $58.92. Just let those numbers sink in for a second. Whether you are absolutely glued to the financial markets every day or you just catch the occasional headline, seeing this kind of price velocity is jarring. But according to our source material today, these thresholds, they aren't just some random coincidence. They are literally the visible tip of a massive structural shift that kicked off long before the mainstream even started paying attention. So, welcome to this explainer. Today we're going to objectively unpack the structural forces and the historical data driving this dramatic, unseen shift in gold and silver. And look, our goal here isn't to sell you a thesis or give you financial advice. We're just here to impartially lay out the data. We're going to look at patterns that confirm current market theories and, just as importantly, the ones that complicate them. Because truly understanding both sides is the only way to get a grip on reality. To make sense of this incredibly complex market, here's our roadmap for today. First, the phase of first moves. Second, the gold-silver ratio. Third, global supply and demand. Fourth, the 1970s historical parallel. And finally, number 5, 3 future scenarios. All right, kicking things off with section 1, the phase of first moves, or the quiet accumulation. Before we can even begin to figure out where this is all going, we have to understand how we got here in the first place. Central to our source's thesis is this concept of the first move. You see, in market history, pretty much every major shift has 2 distinct phases. The first move happens entirely in the shadows. It is this quiet, structural accumulation phase driven by insiders who have actually done their homework. And it usually ends with a price level that practically forces the rest of the world to wake up. Then comes the second move. That one is faster, way more dramatic, and it's heavily fueled by the fear of missing out. The data actually suggests that the massive growth we've seen so far, that was merely the first move. To really grasp the sheer scale of this accumulation, cast your mind back to August of 2018. Gold was hovering right around $1,200. Silver was sitting at just $14. If you had stood up back then and announced that gold would cross $4,000 within 7 years, you literally would have been laughed out of the room. Yet, here we are, a 126% gain in gold and a staggering 168% jump in silver. But here's the paradox. Mainstream sentiment among precious metals investors is still incredibly low. And markets that produce massive price appreciation while nobody is cheering, those are usually driven by durable, structural forces, not just passing investment fads. Moving right along to section 2, the gold-silver ratio, which is really all about mathematical reality. Let's actually run the math to understand why silver is currently moving so much faster than gold. It all comes down to a historically reliable metric, the gold-silver ratio. The calculation is super simple. You just divide today's $4,062 gold price by the $58.92 silver price, and you get roughly 69, meaning it currently takes 69 ounces of silver to buy just 1 single ounce of gold. Now, across the 20th century, that average sat between 55 and 60. So at 69, silver is deeply undervalued relative to gold by historical standard. Looking at the objective arithmetic here paints a truly fascinating picture. Let's play with these numbers. If the ratio simply returns to its historical average of 55, and keep in mind, this assumes gold's price stays exactly where it is today, silver mathematically has to reach $73.86. If it compresses to a bullish 45, silver hits over $90. And if we ever touched that wild 1980 extreme of 17, we would be looking at $238 silver. The absolute key takeaway here is this. Even if gold totally flatlines today, the mathematical case for silver outperforming gold is anchored in a full century of history. Okay, on to section 3, global supply and demand, the physical deficit. But as we all know, ratios don't just exist in a vacuum, right? They are driven by hard physical reality. The global silver market has been in a structural supply deficit for 5 consecutive years. And this isn't just some brief trading hiccup. It means the world is consistently consuming way more silver than it can mine or recycle. Between 2021 and 2025, the data estimates an 820 million ounce shortfall. To put that into perspective, that's basically the equivalent of an entire year of global mine production just vanishing into thin air. Why is this happening? Well, we're seeing rapidly accelerating demand from AI infrastructure, military tech, and a massive global rollout of solar panels. Geographically, this tension is building to a boiling point between 2 massive global players. For years, China was a net exporter of silver. Well, that is violently reversed. China is now aggressively stockpiling, recording a record 1,626 tons of silver net imports in just the first quarter of 2026. Unbelievable. On the other side of the equation, we have India. India's primary commodities exchange recently reported having only about 17 days of silver supply left. So you have a 1.4 billion population with a millennia-old cultural hunger for precious metals pressing right up against extreme historic supply constraints. And crucially, this isn't just some fringe internet theory. We are seeing major signals from the most sophisticated pools of capital on the planet. A Bank of America institutional survey shows that fund managers now regard gold as the most undervalued asset since March of 2023. Add to this the fact that developing world central banks have been scooping up gold at a pace exceeding 1,000 tons per year for 3 consecutive years. What we're witnessing is an unprecedented institutional flight from paper assets directly into physical reality. Which brings us to Section 4, the 1970s historical parallel, patterns, and, well, pain. To properly contextualize all these forces, analysts love to point to the 1970s. But our source insists we need to look at that decade without the rose-tinted glasses. Because yes, the conditions were eerily similar. Monetary instability after Nixon took the dollar off gold in '71, wild fiscal imbalances, zero institutional confidence. And sure, the gains were spectacular. Gold rose 17 times over, silver 38 times. But it was absolutely not a smooth ride. That famous spike to $50 in January of 1980, that was largely driven by the billionaire Hunt brothers trying and spectacularly failing to corner the global market. When their hubris caught up to them, silver collapsed down to $10 in a matter of weeks, just incinerating wealth for anyone who stuck around too long. History is a very strict teacher, folks. Markets never, ever move in straight lines. Finally, Section 5. 3 future scenarios. Let's map out the outcomes. So, taking all this data into account, what actually comes next? A careful observer has to weigh all these options impartially. Our source material projects 3 very unvarnished scenarios. In the bull case, structural factors compound, assisted by new clearing exchanges like the one launching in Hong Kong, routing physical metal outside Western systems. In this scenario, gold could test $4,500 within 12 months, and silver hits somewhere between $75 and $85. Then there's the base scenario, where the market takes a bit of a breather. Gold consolidates between $3,800 and $4,200, and silver pulls back to the low 50s. And this isn't a failure, by the way. It's a healthy consolidation phase. Finally, we absolutely must acknowledge the bear scenario. If a restrictive Federal Reserve steps in under someone like Walsh, the dollar strengthens materially and geopolitical tensions cool off, gold could retreat to $3,400, pulling silver back to the mid-40s. Any prudent analysis requires accepting that this risk is very real. Which perfectly leads into this century-old wisdom from legendary trader Jesse Livermore. It really distills our source's final takeaway. It was never his thinking that made him his money, it was his sitting. An investor who builds a thesis grounded in structural reality must also possess the emotional discipline to survive the bear cases and to endure the boring consolidation of the base cases. Historical wealth in these kinds of shifts is ultimately built on the discipline to just sit tight during periods of maximum discomfort. As we wrap up this explainer, the writing is clearly on the wall. From 820 million ounce deficits to unprecedented central bank buying, the quiet, objective question that history is asking right now isn't really what the market is going to do. It's simply, when the next phase finally arrives and the rest of the world wakes up to the math, where exactly will you be sitting?